Today, we are strapping ourselves into a time machine and traveling straight to Omaha, Nebraska.
Okay.
We're going to take 80 years of hard-won financial analysis experience from Warren Buffett and boil it all down.
Right down into 5 ultra-simple rules.
Exactly. These are the shortcuts that let him analyze the absolute financial core of a company, its balance sheet in, well, what they say is just a few seconds.
That's right. Our mission today is to give you a powerful mental checklist.
Yeah.
We aren't just summarizing Buffett's 5-second balance sheet test.
No.
We want to give you the rationale, the deeper logic behind why these specific figures are the ultimate indicators of a company's health.
Exactly. I mean, the balance sheet is the most foundational financial statement there is. It shows what a company owns and what it owes at a single moment in time.
And it's all governed by that one simple truth. Assets must always equal liabilities plus shareholders' equity.
You can't cheat that equation.
Right. And by using these 5 rules, you get a shortcut to seeing which side of that equation is truly driving value. Is the company building wealth through genuine internal strength, equity?
Or is it relying heavily on external risk, which is liabilities?
Precisely. The goal here, for you, is to understand how to screen companies quickly for that durable underlying financial power, no matter what the stock market is doing.
Okay, let's unpack this.
Let's start with the first 3 rules. Together, they really establish this principle of financial independence.
Rule number 1 is beautifully direct. It focuses purely on cash versus total debt.
And the standard couldn't be clearer. A company should have more cash and cash equivalents on its balance sheet than it has in total debt.
So if you pull up a statement and see, let's say, $3 billion in cash and stuff they could sell tomorrow.
Marketable securities, yeah.
And they only have, say, $1.5 billion in total debt. That's an immediate resounding pass.
Right. Buffett fundamentally loves companies that are so phenomenally profitable, so good at generating cash, that they're basically independent.
They don't need anyone else's money.
Exactly. He wants a company that could, if it wanted to, pay off every single dollar it owes just by, checking its savings account. It signals operational superiority.
It's the ultimate sign that the business model itself is a cash-producing machine.
Yeah.
It's not one that constantly needs to feed on external credit.
Precisely. And that philosophy flows directly into rule number 2, which is the debt-to-equity ratio.
And this is where he introduces a very specific threshold.
He wants to see total liabilities divided by shareholders' equity come in below 0.8.
Okay, so this ratio tells you the capitalization story, right? How much of the company is funded by debt versus how much is financed by the owner's equity?
Right, the money that's been invested or just built up from profits over time.
So let's use a simple example. If a company has $4,000 in liabilities but a really robust $12,000 in equity, the ratio is 0.33. Strong pass.
A very strong pass.
But wait, 0.8 seems kind of arbitrary. Why not a clean 1.0? What's the danger zone you hit at 0.9 that's not there at 0.8?
Well, that 0.8, that's Buffett's margin of safety. If the number is way below 1.0, it means equity is doing all the heavy lifting.
Okay.
At 1.0, the company is equally financed by creditors and owners. But once you creep past 0.8, you're getting into a zone where lenders have a pretty significant claim on the company's assets.
So it's about minimizing risk.
It's all about minimizing risk. If that ratio is below 0.8, it just confirms the company finances itself, and it has managed to avoid a lot of external borrowing. That gives it flexibility in a downturn. It's like a proxy for how much management trusts its own engine over a bank loan.
So we've established the need for a massive cash cushion and low dependency on debt. The third rule is arguably the easiest to check. It might literally take 1 second.
It really might. It's about preferred stock.
And what's the rule?
This is essentially a zero-tolerance policy. Preferred stock must equal 0 on the balance sheet, period.
You'll find this usually nestled right next to common stock in the shareholders' equity section. If you see it, what does that instantly tell you?
It tells you the company was probably in a position of weakness when it raised that capital.
Huh.
Preferred stock is a hybrid security. It pays a fixed dividend like a bond, but it's technically classified as equity. The simple truth is that strong, financially powerful companies, the financial powerhouses we're looking for, they never need to issue preferred stock.
It's often viewed as a last resort, isn't it?
Exactly. If a company issues preferred stock, it often suggests they couldn't get cheaper debt financing because banks thought they were too risky.
Or they couldn't issue common stock without hurting their existing shareholders.
Right, without diluting them at a bad price. It just signals a degree of financial desperation or vulnerability, and that's a huge red flag. 0 preferred stock means maximum health.
Okay, that wraps up the 3 rules for financial independence. Now let's talk about the future. Rules 4 and 5 look less at what the company has and more at what it does with its money.
Yeah, this is about durability, growth, and how management treats its shareholders. Rule number 4 looks at retained earnings.
which many people call the most crucial long-term indicator of profitability.
I agree with that.
Retained earnings, which sits right there in the equity section, is the cumulative profit the company has earned since day one, minus all the dividends it's ever paid out.
And the rule is that this number must not only be positive, it must consistently grow year after year after year.
This point is so critical. Growing retained earnings means the company is consistently profitable, and vitally, it is reinvesting some of that profit back into the business.
For future growth, yeah.
And here's the essential Buffett nuance. They must keep that growth going, especially during recessions.
Yes, that's the stress test. If the retained earnings figure dips during a bad economy, it suggests the company's competitive advantage isn't durable. It's not strong enough.
But a company that keeps growing its profits and keeps reinvesting them through downturns.
That is demonstrating the ultimate form of resilience. It proves it has a powerful, enduring moat around its business. That's the true test. It's what separates the truly great companies from the merely good ones.
Okay, that brings us to the final rule, rule number 5, which is all about capital allocation and management's respect for shareholders. Treasury stock.
The standard here is simple. The company must have some treasury stock on the balance sheet. And ideally, that figure should be growing.
Let's just clarify that for everyone listening. Treasury stock is just the cumulative amount of the company's own shares that it has bought back from the market.
It's the result of stock buybacks.
Okay, but hold on. It's recorded as a negative number, right? That can be confusing.
It is confusing, and that's just an accounting quirk. It reduces the book value of equity. But what you're looking for is the existence and the size of that buyback activity.
So a bigger negative number is actually a good thing in this context.
Exactly. The fact that the number exists and is getting bigger proves management is putting its money where its mouth is.
Right.
It shows they're using excess cash, not just to run the business, but to actively return capital to shareholders.
By reducing the share count.
Which makes every remaining share more valuable. It's a huge signal. Management is essentially saying, we think our stock is the best investment we can make right now.
It signifies a real commitment to enhancing shareholder value.
So if a company generates cash, rule 1, using a little debt, rule 2, avoids desperate financing, rule 3, grows its reinvested profits consistently, rule 4, and uses excess cash intelligently to enhance shareholder value, rule 5.
You found yourself a financial powerhouse.
You have.
Fantastic. So those are the 5 ultra-simple tests. Now, let's make this real. Here's where it gets really interesting. We're going to apply these simple rules to a massive real-world company, Chipotle Mexican Grill, ticker symbol CMG.
This is the vital step. It shows you how quickly you can screen a company just by looking at the high-level figures. Let's start with the easy passes.
Rule 1, cash versus debt. CMG's balance sheet shows about $1.42 billion in cash and short-term investments.
And crucially, if you scan their liabilities, the word debt, traditional bank loans, corporate bonds, it's not there.
They are essentially debt-free in the traditional sense.
That's the easiest pass you can possibly get on Rule 1. Plenty of cash, zero traditional debt. Okay. They are the definition of financial independence.
Okay. Rule 3, preferred stock.
We check the equity section. Common stock, retained earnings, treasury stock.
No preferred stock. 0. Exactly what Buffett wants. Pass.
Moving to Rule 4, retained earnings growth. A quick look shows CMG's retained earnings have consistently grown for many years in a row.
And what's really remarkable is that this figure kept going up even during 2020 and 2021. I mean, a terrible time for the restaurant industry.
A terrible time. They proved their resilience when it mattered most. Another pass.
And finally, Rule 5, treasury stock.
A look at their equity section shows CMG has bought back over $5 billion of its own stock, cumulatively. And that figure is increasing.
Which confirms they are actively allocating capital back to shareholders. Pass. So 4 out of 5 rules passed with absolute flying colors.
Which brings us to the final test. Rule 2, the debt-to-equity ratio, where the initial raw numbers actually cause a failure.
And this is where the real lesson about critical thinking comes in.
It really is.
The reported raw number for CMG's debt-to-equity ratio is listed as 1.2.
1.2.
Remember, Buffett's hard threshold is 0.8. So if we stopped our analysis right here, CMG would fail Rule 2, and we might just toss the company aside.
And that would be a huge mistake. This is the moment to remember that these rules are guides. They're based on financial philosophy, not rigid laws dictated by accounting standards.
You have to look at why that ratio is 1.2.
Right. because the financial health we saw in the first 4 rules just doesn't line up with a failing debt ratio. Something's off.
And there are 2 complex accounting things actively pushing that number up. The first is on the liability side. CMG's total liabilities are about $5 billion.
The largest single liability, about $3.9 billion of that, is categorized as long-term leases.
This is crucial. Since recent accounting rules changed, long-term operational leases, which are basically just promises to pay rent on all their restaurants in the future,
They now have to be classified on the balance sheet as a liability, almost like debt.
So are you saying we should just ignore the official accounting rules here and think like an owner?
In essence, yes. These are just future rent payments. They're not problematic debt in the same way a bank loan is. And analysts would look at those and see them as operational necessities, not as a sign of financial risk. That's nuance point 1.
Okay, nuance point 2 is on the equity side. CMG's total shareholder equity is listed at $3.3 billion. But we just said they have over $5 billion in treasury stock.
And remember how we said that treasury stock, those buybacks, are recorded in a way that actively pulls down the total shareholder equity figure?
Ah, right.
By aggressively buying back shares, CMG is making its equity base appear artificially smaller than it really is, and a smaller denominator in that calculation automatically inflates the ratio.
So they're literally being punished on paper for being so shareholder-friendly.
That is the perfect way to put it.
That's fascinating. So they have almost zero traditional debt, but their ratio looks bad because they have to pay rent, and they're so good at returning capital to shareholders, they've shrunk their own book equity.
Exactly. If you manually adjust the calculation, if you view the leases differently and account for the reduction caused by those massive buybacks, the company's effective debt-to-equity ratio would fall dramatically, far below the 0.8 figure.
The underlying financial strength is absolutely there.
Undeniably.
Wow, that is the perfect example of why you can't just run numbers through a calculator and walk away. While the raw number fails, applying critical thinking and adjusting for CMG's unique structure leads us to the real conclusion.
Which is that Rule 2 gets a check. It's a pass, with necessary nuance.
A definite pass.
So in the end, Chipotle passed all 5 tests once we applied that layer of critical thought. This just demonstrates the immense value of Buffett's system. It gives you a fast, reliable way to screen companies, but it absolutely requires you to understand the why behind the numbers.
Knowledge is most valuable when you apply it, not just memorize it.
Exactly.
So what does this all mean? Well, you now possess a powerful, streamlined checklist inspired by the greatest investor of all time. You can quickly screen companies for deep, foundational financial strength, independence, durability, and shareholder-friendly management before you even dive into the deeper stuff.
It truly is a shortcut to being well-informed.
It is.
And as you take these 5 rules out into the financial world, just remember that not all companies operate like a restaurant chain.
That's a great point.
We analyzed a company with predictable revenue and, not a lot of fixed assets. But how might the lease issue or the debt-to-equity ratio need more adjustment if you are analyzing, say, a cyclical manufacturing company that has to carry debt to fund massive inventory?
Or a high-growth tech company that's designed to use debt to scale quickly.
Exactly. This raises an important question. Where else might these simple rules need adjustment based on industry specifics? It's something for you to mull over or explore on your own.